Morning students, I hope I am audible. Welcome to Ekcel Academy's CSEET crash course. Today we'll be looking at business, environment and economics subject. Before that, a quick announcement on a few of the things which we do at Ekcel Academy. So now you may have taken up CS Executive or CSEET. Of course, for CSEET we have been conducting this crash course since few days now, which is of course free of cost. And also let me remind you that by clicking on the link in the description, you will be taken to our website, that is excelacademy.com with EKCL. There you can sign up for the free CSEET course, wherein you will get all the lessons arranged neatly in chronological order with various examples, because as I already mentioned, this is a crash course. We may or may not be able to cover the entire syllabus in few days, in few hours. So that is one limitation. What we are trying to do is trying to revise certain topics which we believe to be important from the point of view of exams. But you can always visit our website, register for the course and take full advantage of that. And if you are a CS executive student, then of course we have been mentioning this often, that the unique thing about Ekcel Academy's program for CS executive is the mentorship thing, wherein someone from our team will be hand-holding you and guiding you throughout your course duration. So we'll be monitoring closely your progress with respect to the coverage of the syllabus, and also if at all you get stuck somewhere, you can always get back to us through our mentors, or rather your mentors. Now, the things which we do at Ekcel Academy, we conduct classes for CS Executive Foundation as well as that is CSEET, and as well as for professional. Now, we conduct classes only in English. We have both recorded as well as live classes, because sometimes it may not be possible for you to watch the live session. So we always have the recorded session uploaded. On top of that, what we do is we conduct at least twice or sometimes once in a week live sessions for the recorded ones, so that if at all you have any doubts with respect to that, you can get your doubts clarified. Even those sessions are uploaded ultimately. Then you get notes for all the topics, all the subjects rather, so you can make use of that. And we also conduct this unique session called Study With Me group discussions, wherein someone from our team will be live studying, so you can get inspired by them and study along with them. That's nothing else will happen during that session. You just keep on studying for hours together. So yeah, on top of that, if you register on our website, you will also get daily quizzes, weekly tests, mock tests, etc. All these are very important, especially the mock test, because many students, what they do is they prepare for the exam, but ultimately they will be looking at the question paper for the first time in the final exam, which I believe is not the ideal way to approach the exam. I would suggest be well prepared, but at the same time be also be prepared with the type of examination which the institute conducts, that you can do only by appearing for the mock tests. So I would suggest take advantage of that too. Anyway, now that the announcements are done, let's quickly move to the lesson itself. Okay, we had stopped here. We looked at the real GDP and we'll continue from there. Okay, then we have something known as GDP Deflator. Let's see what exactly quickly. GDP Deflator is an index of price changes of goods and services included in GDP. So it's kind of an index which will tell us the change in the level of goods and prices. It is a price index which is calculated by dividing the nominal GDP in any given year. So this would be the current year GDP, that is called the nominal GDP for the same year, and by the real GDP for the same year. So that will be divided by the real or the constant GDP with constant prices, and then you multiply by 100, you will get the GDP deflator. We have already seen all this. So let's move on to the next topic, which is gross national product. Now, what is this gross national product and how is it different from gross domestic product? Okay, let's see. Now, they say GNP is the total measure of the flow of goods and services at market value resulting from current production during a year in country. This is where it differs now, including a net income from abroad. So we are not only looking at the goods and services market value resulting from current production during a year, any particular year in the country, but also net income from abroad. So if you are including net income from abroad, so then we call it gross national product. Let's see what are the different types of goods and services which we include. So GNP includes 4 types of final goods and services. Okay, let's see which are those 4 types. Consumer goods and services to satisfy the immediate wants of the people. Gross private domestic investment. So okay, private investment is also considered in capital goods consisting of fixed capital formation, residential construction, inventories of finished and unfinished goods. All these will be part of private domestic investment. Goods and services produced by the government. Okay. Net exports of goods and services. Net exports means actually the difference between the value of exports and imports. Okay. So that is what they say. Okay, let's see what are the factors which we need to consider when it comes to GNP. GNP is the measure of money in which all kinds of goods and services produced in a country during 1 year are measured in terms of money at current prices and then added together. They say that's okay, we've already seen that. In estimating the GNP of the economy, the market price of only the final products should be taken into account. Okay, that is also fine. Many of the products pass through number of stages before they are ultimately purchased by the consumers. Okay, what they're trying to say is don't consider the intermediate stages. Any product, or rather many products, pass through different stages. Only consider that stage which is considered as final. Before that there may be 100 different stages. Just ignore. At the final stage, whatever is the value of that product, consider that. That is what we are supposed to do. Why should we do that? Because if you count at every stage, then you will be simply duplicating stuff. I included stage 1, maybe preliminary stage, then stage 2, further processing of raw materials, then stage 3 before the final product, there is one more processing, let's say. So now we have 3 different stages before the final product. So now if I count this or count its value for every stage, then and again add the final product also, then it will be nothing but duplication. So if that would simply defeat the purpose of the GNP, and it will give us a misleading GNP. So therefore we will have to only consider the final products. Next, goods and services rendered free of charge are not included in GNP because it is not possible to have a correct estimate of their market price. For instance, the CSEET crash course which we are doing right now is free of cost. We cannot consider that for GNP because you cannot estimate their market price. What is the value of that? No, we can't estimate. So therefore, such things which are provided for free cannot be included. So then fourth, the transactions which do not arise from the produce of current year or which do not contribute in any way to production are not included in GNP. If it is not related to current year or if it does not contribute in any way to the production, then they are not included in GNP, they say. Fine. That is the sale and purchase of the sale and purchase of old goods not produced during the year, and of shares, bonds and assets of existing companies are not included in GNP because these do not make any addition. This is very important. Are they adding to the national product? Are they adding to the national product? No. Or are they simply getting transferred? Obviously they are simply getting transferred, so therefore not included. One more thing, the payments received under social security like Manrega, rural employment guarantee scheme. So if you receive any money from such social security measures, what should we do? They say unemployment insurance allowance, old age pension, interest on public loans are also not included in GNP because the recipients do not provide any service in lieu of them. But we cannot say the same thing for Manrega because you provide some service and because of that you get some money. But if you are getting any unemployment insurance allowance wherein you are not doing anything, you are unemployed and the state is giving you some kind of insurance allowance, or old age pension or interest on public loans, they are all not part because there is no service which is provided in exchange of them. Okay. Then at the same time, they also say the depreciation of machines, plants, and other capital goods are not deducted from GNP. Okay. The profits earned or losses incurred on account of changes in capital assets as a result of fluctuations in market prices are also not included in GNP. That means, let's say you have bought some property for 1 crore and the value of the property in 6 months has increased to 1.25 crore. Now, any change in the value of the capital asset will also not be included because they are not responsible for current production or economic activity. You didn't do anything to increase the value. Did you build anything on top of the existing structure for it to increase its value? Obviously not. It just was lying around due to market forces. The price of the commodity, or rather the capital asset in this case, increased and therefore not considered as part of GNP. Moving on. 3 approaches to GNP. Let's see. There are a few examples for the various topics which we discussed earlier. Go through those. Fairly self-explanatory. 3 approaches to GNP. Let's see what are these 3 approaches. Income method to GNP. The income method to GNP consists of remuneration paid in terms of money to the factors of production. Okay. So which are those factors of production? What is the remuneration paid? Let's see. Let's say human resource, wages and salaries. You pay that. So whatever wages and salaries are earned through productive activities by workers and entrepreneurs, that will be considered. What all does it include? It includes sums received or deposited during a year by way of all types of contributions like overtime, commission, provident fund, insurance, etc. Whatever you get in whatever name you get for the productive activities which you have done. Otherwise, not counted. Next, rent. Total rent includes rents of land, shop, house, factory, etc. Whatever you use for producing something. And the estimated rents of all such assets as are used by the owner themselves. Sometimes you use the asset which is your own for the production. So for that we'll have to calculate the notional rent. That also will be considered. Interest. Under interest comes the income by way of interest received by the individual of a country from different sources. Okay, let's see which are those. To this is added the estimated interest on the private capital which is invested and not borrowed by the businessman in his personal business. That means you are investing out of your own savings, not out of some loan, not by borrowing from someone else. Okay, next. Dividends. Dividends earned by the shareholders from companies are included in the GNP. Fine. Undistributed profits, or rather corporate profits, meaning the profits which the companies have earned and what the companies have not distributed those as dividend or maybe bonus. So if they retain them, they are also included in GNP. Then we have mixed incomes. These include profit of unincorporated business, self-employed persons and partnership, meaning all those non-corporate business incomes. Direct taxes which are levied on individuals, companies and other businesses are also included as part of that. Then comes the indirect taxes. Indirect taxes, we know now it's mostly GST, which has brought everything under its umbrella. These taxes are included in the price of commodity, but the revenue from these goes to the government treasury and not to the factors of production. Therefore, the income due to such taxes is added to GNP, they say. Okay, fine. Depreciation. Every corporation makes allowance for expenditure on wearing out and depreciation of machines, plants, and other capital requirement. Since this sum is also not part of income received by the factors of production, it is therefore also included in GNP. Okay, if it is not part of the income of factors of production, they say they will include it here. Next, net income earned from abroad. This is the difference between the value of exports, how much we are exporting with respect to goods and services, and how much we are importing the same, different goods and services. If there is a difference, let's say there is a positive difference. Positive difference means our exports value are more than our import value. So in such a case, we say there is a positive difference. So it is added to GNP. But if it is a negative difference, meaning vice versa, imports are more than exports, which is usually the case with India, then it will be deducted from GNP. Again, they have given the formula here, whatever we discussed earlier. So the same thing has been presented here as a formula. Let's move on to the next method, which is the expenditure method. How do we calculate GNP using this method? It includes the following items. Let's see which are those items. Private consumption expenditure. It includes all types of expenditure on personal consumption by the individuals. Okay, whatever you consume for yourself. It comprises expenses on durable goods. Maybe you want to buy an expensive car or watch, whatever. It will be considered. Expenditure on single-used consumers goods like milk, bread, etc. Whatever you spend on such things also. And expenditure incurred on services of all kinds like fees for school, doctor, lawyer, company secretary. So all these are considered as final goods. So these are the items which are spent by an individual, private individual. Next, gross domestic private investment. This is private expenditure. This is private investment. Let's see what do we have in store here. Under this comes the expenditure incurred by private enterprise on new investment. If you are investing elsewhere for the first time, let's say you are investing in a business or a friend's business, and if you are replacing old capital, in such a circumstance, we say it is gross domestic private investment. That will also be part of GNP. Okay, next, net foreign investment. It means the difference between the exports and imports or export surplus we already seen in the income approach. The same thing is considered here too. Government expenditure on goods and services. The expenditure incurred by the government on goods and services is part of GNP. Central, state or whichever local governments, they spend a lot on their employees, that is salary. They also spend a lot on law and order, that is police and army. To run these offices, the governments have also to spend on contingencies, which includes things like this. So whatever they spend on basically will be part of GNP. So again, we have a formula with respect to expenditure approach. Let's move on to the next approach, which is value added approach. The money value of the final goods, and the services produced at current prices during a year is taken into account. So now let's see what exactly they do. For instance, raw materials, semi-finished products, fuels and services are all sold as inputs by one industry to other. They may be final goods for one industry. Of course, yes, because someone might just be preparing a raw material. Let's say there might be a company which will only produce chains and sprockets. That is a finished goods for that particular company. But for a two-wheeler or a four-wheeler company, that is only one of the raw materials. Okay. So to avoid duplication, the value of intermediate products used in manufacturing final products must be subtracted from the value of total output of each industry in the economy. That means if you are using intermediate products, then what we'll do is we'll deduct that. So thus the difference between the value of material outputs and the inputs at each stage of production is called value added. That means, let's say there is a vehicle which is being manufactured, two-wheeler. Let's look at a bike itself. So if you are manufacturing a bike, the bike will have some final output value. We'll consider that. But whatever the inputs the bike has used, that is the various raw materials, it will have some value, no? Since each of those raw materials would be final product for someone else already, what we'll do is we'll deduct the value of those raw materials from the final output value of the bike. So the difference would be the value added. How much value have you added by finally manufacturing this two-wheeler bike? Is it more than the value of all the inputs? Obviously it will be normally. So that would be considered as the value added. So to avoid duplication, you can use this method as well. So now what is this GNP at market prices? GNP at market prices is nothing but GDP, gross domestic product at market price, plus net income from abroad. That's all. Whatever is the GDP, to that what should we do? To get GNP at market prices, add the net income from abroad. So you will get it. So let's also look at GNP at factor cost. So I would suggest please remember all these formulas, so that if at all there is a question related to the formula or something of that sort, you should be able to answer quickly. Because the more time you spend thinking in the exam, the more time you will be wasting, and it may be difficult for you to answer other questions which may also require equal amount of time. So the moment you start thinking in any exam hall, you already lost the battle. So you should not be thinking too much. Once in a while for 1 or 2 questions you can. Otherwise, the moment you look at the question, you should be able to recall the answer. Next. GNP at factor cost is the sum of the money value of the income produced by and accruing to the various factors of production in 1 year, less the indirect taxes. What is the GNP? From that you deduct indirect taxes, and to that add subsidies from the government. Subsidy, why will the government give subsidy? Like they will subsidize certain things. That means if the price of any commodities is, let's say, 100 rupees, they may subsidize that for people from lower strata or economically weaker section of the society to just about 50 rupees or maybe 20 rupees or whatever it is. So that subsidy will also be considered here. Next, moving on. Net national product. So it is nothing but the total value of consumption of goods and investment goods, but the process of production uses a certain amount of fixed capital, they say. Some fixed equipment wears out, which is natural. Its other components are damaged or destroyed, that's why we have depreciation. And still others are rendered obsolete through technological changes. Sometimes some items become obsolete because of the change in technology which is happening rapidly nowadays. All this is nothing but depreciation or capital consumption allowance. We can call it either depreciation or capital consumption allowance. Now, how is this related to NNP? Very simple. In case of net national product, what we'll do is whatever we mentioned earlier, that is depletion or components getting damaged or getting obsolete, etc., which is nothing but depreciation, that will remove from GNP. That's it. If you remove from GNP all the depreciation, you will get only but you'll get nothing but NNP. Yeah, that's it. So this is what we will get. Next, moving on. NNP at factor cost, once again the same thing. GNP at market prices minus depreciation minus indirect taxes plus subsidies. Same thing as GNP at factor cost, but what else are we deducting from here? The additional item which we are deducting here is depreciation. If you look at GNP at factor cost, we deducted indirect taxes and added subsidies. For NNP, we are only deducting one more item, which is the depreciation. That's all. Next, domestic income. Income generated or earned by factors of production within the country from its own resources is nothing but domestic income or domestic product. So what all does it include? Wages and salaries earned, rents, interest, we have already seen all this, dividends, undistributed corporate profits including surpluses of public limited undertaking, that is government companies basically, Mixed incomes consisting of profits of unincorporated firms. It could be self-employed, partnership, etc. And finally, direct taxes. All this will be part of domestic income. That's why they say domestic income includes. It may include something else as well, but this is the major items. These are the major items. Okay. Private income. Private income is income obtained by private individuals from any source, productive or not productive, and the retained income of corporations. So these two can be considered as private income. Whatever an individual earns from any source, whether it is productive or not, and whatever the retained income of the companies, those two can be considered as private income. So they have given a formula as well. You can just understand that it's fairly obvious. Next, personal income. Personal income is nothing but the total income received by the individuals from all sources before we pay the direct taxes. Let's say your total income is 15 lakhs. So this 15 lakhs is before I have paid the, direct tax. So let's say my direct tax is about 2 lakhs. So once I pay the direct tax, that will not be considered as personal income. Personal income is this before I pay. So now what do they say? National income minus undistributed profits, profit taxes, social security contribution, plus transfer payments, plus interest on public debt, all put together, you'll get the personal income. So that is also there. Or it could also be private income when it comes to individuals. This is the formula. When it comes to companies, this formula will be sufficient. Plus undistributed corporate profits, which will not come into my individual's case, minus the taxes. Next, disposable income. Disposable income or personal disposable income means that actual income which can be spent on consumption. Okay, that's it. Whatever income you have, and if you can spend on consumption, that is, if you can spend on buying goods, then that is nothing but your disposable income. Maybe you have income of, let's say, 1 crore, but your disposable income can be only 10 lakhs because you have already borrowed money from several people that you have to pay loan, or rather pay off loans. So therefore the amount of money which you are left with through which you can buy fresh goods is only 10 lakhs. So that becomes your disposable income. Or someone might have only 15 lakhs as income, and entire 15 lakhs of theirs is fully disposable. That means they can buy everything out of those 15 lakhs. In that case, entire 15 lakhs is disposable income because they can spend on consumption. So that is what we have here. Okay, we have a formula for this as well. Let's not get into that because it's fairly obvious. Just have to remember stuff, that's all. Real income. Let's see what is real income now. Real income is national income expressed in terms of general level of prices of a particular year taken as base. This is very interesting. We will consider 1 year as base. Let's say year 2000. For every year's GDP, what we do is we'll try to match that or compare that with this particular year's GDP or national income expressed as a comparison with respect to the base year. The base year in my case is 2000. So then we'll get an idea as to how far we have come. Okay, how far we have progressed. It is possible that the net national product of goods and services this year might have been less than that of last year. Okay, that is possible. But owing to increase in prices, NNP might be higher this year. So what they're trying to say is, if you look at the goods and services produced this year, it might be less than last year, but it might be less because of inflation. So if you consider that into account, maybe NNP might still be higher compared to what happened or what we produced in the previous year. Okay. Or on the contrary, it might be possible that your NNP might have increased, but the price level might have fallen. As a result, national income would appear to be less than that of last year. So that is also possible, reverse situation. In both the situations, income, or rather national income, actually does not respect the real state. how do we rectify or how do we overcome such a situation where our national income is not representing the real state of the economy? So to come out of such a situation, what we can do is we can take particular year as the base. Like this is my base year. I'll compare everything to this base year. So I'll give inflation of that year to be 100, or the price level of that year to be 100. Now next year it will be 110 or 115. That means prices have increased by 14%. That is, the inflation is to the extent of 14%. Likewise, every year we'll keep on adding the actual inflation. So then you'll get the price index. So with the help of price index, we'll compare everything to the base year. So again, there's a formula here, so you can check it out. So the next important concept, which is per capita income. So this is something which you might be already familiar with, but let's still go ahead and see what exactly it is. So this is nothing but the average income of a country. Okay, how do we calculate this average income? Very simple. Whatever is the national income of any country, if you divide that by population of that entire country, you will get the per capita income. Or if you want to know the per capita income of, let's say, your family, so the family income in total, the income of your parents, your mother's income plus father's income plus your siblings' income if they're working, divided by number of people in the family. Let's say there are 5 people. Whatever is the total income, and if you divide that by number of people, let's say 5, you will get what? Per capita income for that household. The same thing can be done for, let's say, an area, locality, district, country, etc. Now, what is this real per capita income? It is nothing but the real national income divided by population. That's all. We've already seen what it is, so let's not get into that. Okay, that's all about chapter 2. We'll proceed to chapter 3 after a break of a couple of minutes. Thank you. We'll be back soon. Let's move on to the next chapter. That is lesson 3, Indian Union Budget. A very interesting topic. Overview of Indian budget. Let's quickly look at the background history of the Indian Union budget. Union budget is a budget which is prepared by the central government basically for the entire country. India is a union of states, as you may already be aware of. Let's read what exactly they have to say. Apparently, the first Indian budget was presented by James Wilson on Feb 1869, more than 100 years ago. After the Indian budget was introduced on April 7th, 1860 by the East India Company. So back then, as you already know, we were still ruled by East India Company. The Britishers had colonized us and plundered our nation. So back then, they had introduced this budget, and it was in 1869 that the first Indian budget was presented by someone named James Wilson. Doesn't really matter. Next, the first budget of independent India was presented by the then finance minister Mr. R.K. Shanmugam Chetty, a South Indian, on November 26, 1947. You better remember this name, Shanmugam Chetty. Date may or may not be important, but the name is definitely important. First independent India's budget presented by a South Indian, R.K. Shanmugam Chetty. Next. Till 1955, budget was only printed in English language. Oh, this is interesting. However, from 55-56, budget started getting printed in both languages, Hindi and English. Okay. Why Hindi though? Because a large majority of North India speaks Hindi. So therefore in Hindi, because South Indians don't matter. So therefore it is Hindi. Anyway, let's move on. In the British era, the budget used to be presented at 5 p.m. Oh my goodness. And this continued for a very long period even after the British era until 2001, when the then government shifted it to 11 a.m. Even now the same timings is more or less maintained. So the budgets are now presented at 11 a.m. instead of 5 p.m. Until 2017, the ritual was to present the budget on the last working day of February up to 2017, just until 5 years ago. But now, since the last 2 years, it has been presented on the first working day of the February. That is interesting. And in the entire history of independent India, only 2 finance ministers could not present the Indian budget. Who are those? K.C. Neogi and H.N. Bahuguna. So these 2 couldn't present any budget, even though they were finance ministers. The record of presenting maximum number of budgets is held by Sri Morarji Desai for presenting 10 budgets. Okay, that's interesting. For the first time in 92 years, Union Budget of 2000 merged the Union Budget with Rail Budget. This is very important. So until then, those 2 always used to be presented separately. The Union Budget, or rather the finance budget, was presented by the finance minister, whereas the other budget, which is the rail budget, was presented by the railway minister. But in 2017, they realized there is no necessity for 2 different budgets. Rail budget can be included in this itself. So they started presenting the railway budget in the finance budget or the union budget itself. When? Since 2017. Again, in 2017, they also started presenting the budget on the first working day of February and not on the last working day. So remember all this kind of interesting history of Indian budgets. Next, what are the key terminologies or various parts or heads covered under the budget? Let's look at it. The first thing is annual financial statement. What is this financial statement? Financial statement generally tells us about the financial position of any entity. How many assets are there, how many liabilities are there, and what are its value, etc. So in this case also it's somewhat similar. Let's see what exactly it is. Now they say Article 112 or 112 of the Constitution requires, mandates, the government to present to Parliament. So the government will have to present to Parliament, which will be comprising of lower house and upper house. Lower house is Lok Sabha, upper house is Rajya Sabha. They will have their members. Lower house, of course, elected members. Rajya Sabha, of course, selected by the legislative assemblies. So that is what we have. Present to a parliament a statement of estimated receipts and expenditure. So this is very interesting. So they are not talking about assets and liabilities, but they are talking about receipts and expenditure, estimated, that too, in respect of every financial year. So financial year for us means April 1st to 31st March. We don't follow this calendar year as financial year. Though this is something which you may already be aware of. So any company in India will always stick to this financial year, whereas calendar year is different. The statement is the annual financial statement. That's it. So it's usually a white 10-page document, they say, divided into three parts, which are those: consolidated fund, contingency fund, and public account. So these are the three documents which will be present in what? In the annual financial statement. So which three? Consolidated fund, then contingency fund, and public account. Now we will see what are these funds actually. First, consolidated fund. What is this consolidated fund now? Okay, this is the most important of all government funds. Okay, all revenues raised by the government, however they are raising, could be direct or indirect, etc. Money borrowed and receipts from loans given by the government. So let's say government has borrowed money from someone, or it has issued loans and received money, to be considered as consolidated fund of India. Whatever revenues the government has raised, whatever loans they have borrowed, and whatever receipts they are getting, in whichever form it is, so all these things would be considered as what? Consolidated fund. All government expenditure is made from this fund. This is very important. So all the government expenditure, whatever it is because of this fund, or it is arising from this, except for exceptional items met from contingency funds. Exceptional items which are not regular in nature. For example, let's say COVID relief measures. In such a case, we cannot use the consolidated fund, because that is for day-to-day affairs of the government. Whereas COVID was a contingency, emergency event, unexpected event which happened. So in such a case, we'll borrow money from contingency fund. Of course, government raised through various voluntary and involuntary donations. That's a different thing. But normally, it will be met from the contingency fund or the public account also. No money can be withdrawn from contingency fund without the approval of Parliament. Unless the Parliament says yes, we cannot borrow money from or withdraw money from consolidated fund. Let's go further. Demand for grants. What is this now? Demand for grants is a form in which estimates of expenses from the consolidated fund included in the annual financial statement and required to be voted upon in Lok Sabha are submitted in pursuance of Article 113 of the Constitution. Basically, what they're trying to say is, now let's say there is some grant which is required, and they want to utilize the consolidated fund for that particular grant. So then what do? You ask the government, or you ask the Parliament rather, or request them to approve that particular thing. So because we have already given you the estimate, like where we will be spending this, so that is nothing but the demand for grant. But you have to withdraw money from consolidated fund, because we have already seen that without the approval of Parliament we cannot withdraw anything. We will put forth in front of them saying, this is what we are intending to use this money for, please grant us the permission. So that is what is called demand for grant. Next, appropriation bill. What is this appropriation bill? It gives power to the government to withdraw funds from consolidated fund for meeting expenditure during the financial year. So that is a general permission which is given to the government. So after the discussions of the budget and voting on demand for grants, the government introduces the appropriation bill. So now what happens? You have asked money for specific funds. You have raised demand for grants. let's say they have been passed. Now you are asking for, or rather you are passing the appropriation bill or presenting the appropriation bill in front of the parliament. So now what will that do? It will give you the authority to what? To withdraw money from the consolidated fund so that you can meet the various expenses during the financial year. Not everything will be passed through demand grant. Most of it will come through appropriation bill. Next, because every time you have to spend on some small thing, you cannot come to parliament and ask the parliament to approve that. So therefore what the parliament does is, it will give you one general blanket permission saying, okay, you spend it for all the expenses which you have mentioned already. So for that they will give permission. Next, finance bill. Okay. This is one of the major important parts of any union budget. Let's see what it is. Finance bill is a money bill as defined in article 110 of the constitution. Okay, now you may think, should I remember all these articles? We have already seen 3 articles of constitution. If it is possible to remember, well and good, because who knows what type of question the institute will ask in the final exam. It's MCQ or objective type of question. Wherever they can find such questions, they will ask such questions. So they may even ask which article of the constitution defines finance bill. Then they will give choices like 110, 113, 105, whatever it is. So in such a circumstance it might be difficult, so better to memorize, that's it. So now what do we have in finance bill? The proposals of the government for levy of new taxes. So let's say now all of a sudden the government of India, they levied new tax called Swachh Bharat cess, because they wanted to keep the country clean. So for that we need extra money. So where do we get the money from? So therefore they levied a new cess. Now the power to levy that cess comes from finance bill. That is what we do in finance bill. The proposals of the government to levy new taxes, modification of the existing tax structure, like for example, normally the governments change this slab rate of income tax every once in 2-3 years. So how do they do this? Through finance bill only. They will modify. Okay, so that is coming under finance bill. So now they say finance bill can be introduced only in Lok Sabha. This is also very important. But Rajya Sabha can still recommend amendments in the bill, but Rajya Sabha will have no say when it comes to approval. But this finance bill, whatever it is, has to be passed by the parliament within 75 days of its introduction. That means if you introduce this on, let's say Jan 1st of 2022, you introduce this finance bill, and till date you haven't passed this, that means the bill would have lapsed by now, because within 75 days of introduction it has to be passed. Next, moving on to the contingency fund. We have already seen, whenever there is an unexpected event, emergency situation, then the government will not borrow money from consolidated fund, but instead they will utilize the contingency fund, which is kept aside for such a situation anyway. Next, public account. So why do we need this account? The fund is to account for flows of those transactions where the government is merely acting as a banker. That means I take your money, I give it to someone else. I mean, not on my own account, but only as a banker. So okay, for example, whatever money you deposit in provident fund, that will be taken care by government. It's not their money, or any small savings, not their money, but they'll be like treasurers of such money. Okay, so the government is merely acting as a banker, meaning if you deposit money in a bank, or if you have an FD in a bank, the banker will only act as the guardian of that particular thing, not as anything else. These funds do not belong to the government, that we already know. They have to be paid back at some point of time to the rightful owners. Who are the rightful owners in case of PPF? The person who has contributed to the PPF, they will be the rightful owners. So government will have to at some point of time give it back to them. So they cannot have it permanently. Same thing with banks as well. No? The government also is acting like that. For each of these funds, the government has to present a statement of receipts and expenditure. Meaning the government will have to tell the parliament saying, look, we received so much of provident fund this year. What are we doing with that? Because what they're supposed to do with that matters a lot, because if they spend it without any care, then if at all they have to return that money tomorrow, if large number of people want to borrow money from provident fund, and if the government does not actually have the fund because they spent recklessly from that fund, then it will be an issue. So therefore the government has to be very careful when dealing with such funds, for which it can only act as a banker, not as anything else. Next, revenue receipt or expenditure. All receipts and expenditure that in general do not entail sale or creation of assets are included under revenue account. That means if you are getting money or if you are spending money which will not create an asset or reduce an asset, then it is nothing but revenue account. Okay, it's like any other business. All those non-recurring items which the business transacts in will come under the P&L. All those recurring items which does not create any assets, then it comes under P&L. All those non-recurring items will come under the balance sheet. So same thing is happening here also. Examples being for revenue receipts and expenditures, salary, subsidy, interest payments, etc. Because salary is something which you'll have to pay every month, no? So it does not create any fixed asset. So that's why it's a revenue expenditure. The reverse of this would be capital expenditure, wherein you don't have to incur this expenditure again and again, but it will create some kind of asset or it will reduce some kind of asset. So that is what happens in case of capital expenditure or capital receipt. So that is about that. Okay, let's see what exactly they do with respect to budget preparation. Preparing a budget is extremely tedious, okay, and lengthy, difficult and lengthy process. How does it begin? It begins with the budget division issuing circular to all ministries. Whichever ministry it is, they will issue a circular saying, we'll be preparing the budget, state your requirements. So they will send the same circular to states, union territories and various autonomous bodies, because those autonomous bodies will be depending on government for, let's say, various activities. So they will be asked to submit their expenditure estimate, meaning let's say there is an autonomous body, let's say CBI for instance. Now CBI is an autonomous body and that body needs money from government. So now what they will do is they will in advance they will tell the government saying, this is our expenditure estimate for the next year, please consider this while preparing the budget. Now the government will think about this expense also while preparing the budget, because they also need money. They may be autonomous, but they depend on government for the money. So that is what happens. The same thing happens with various other autonomous bodies. It could be ministry as well, like say cultural ministry. So cultural ministry will have to dish out money to various cultural activities to promote cultural activities. If they don't promote, then all these things may or may not take place. So therefore they will also submit their proposal. So then the government will consider that too and then incorporate everything in the budget, because the government has to do this monkey balancing. No, someone might all of a sudden ask for too much money. Let's say defense ministry, they might think that we will need too many missiles this year, or maybe we have to import helicopters, MiG aircrafts. So in such a case, all of a sudden the defense budget shoots up. Now if the defense ministry is asking too much money compared to last year, now where do I cut down? Because my income has not increased. So then they'll have to cut down somewhere else within all these departments and states and union territories, etc. Because we have already, in economics, this is a universal concept wherein we say wants are always unlimited, but when it comes to the sources, the means, it's always limited. Moving on. In the meantime, the Department of Economic Affairs and the Department of Revenue meet stakeholders such as farmers, businessmen, Federation of Industries, economists and civil society groups to take their views. So they also do this. They meet various industry people and people who matter and take their views as well. Like, what is that you want us to do? Do you want us to include something in the budget? Is there anything which you wish to be included in the budget so that we can incorporate that too? So that is the thing. Once all this has been done, then they will finally, prepare the budget. So without incorporating the views of various people, without incorporating the requests of various states, union territories, there is no budget, because budget is made for them, right? Anyway, let's move on. So what are the various speech parts, the parts of speech in different contexts here? Of course, the parts of speech here refers to the parts of budget speech. Annual financial statement, we already seen. Demand for grants, appropriation bill, finance bill. Macroeconomic framework for the relevant financial year, what the government wants to do with respect to macroeconomic framework, not micro. Medium term fiscal policy and strategy statement, very hi-fi language used but not that difficult to understand. Expenditure profile, expenditure budget, receipts budget. So all these will be part of the union budget. Okay, let's look at each of those. Revenue budgets, or revenue budget for that matter. Revenue budget records all the revenue receipts and expenditure. Only revenue receipts and expenditure, not capital receipts. If the revenue expense is more than that of receipts, if the revenue expense is more than receipts, indicates there is a revenue deficit. That means we are spending more than what we are earning, so that will be deficit. Revenue expenditure is for normal running of government departments and various services, interest payments on debt, subsidies, etc. So day to day functioning of the government, for that we need the revenue budget. For example, government has various departments under it. Let's say income tax department, GST department. For all those departments, the government will have to spend on salaries. They will have to calculate like so many employees are there in this department, so we'll have to pay them X amount of salary. So many people might retire, so many people might get promoted, so we'll have to increase the salary during that point of time. So we'll have to make provisions for all this. That is what they will worry about. Then comes the capital budget. So accounts for capital payment and receipts of the government. So that which is not part of the day-to-day activity, something which is not done recurringly. So capital receipts, how do the government get money? Loans from public, capital receipt. Loans from RBI. So if the government raise money from public, like through market loans, deposits, etc., then it is nothing but borrow from public. That is also a capital receipt, because you don't have to pay back that immediately. All these deposits which the government raise, that will be repaid over a period of, let's say, 5 years, 10 years, 15 years, like that. At the same time, the government can also borrow money from RBI and other parties, maybe other banks as well, through treasury bill sale. Loans received from foreign bodies. Government can also receive money from other foreign bodies, and governments maybe from other foreign governments as well. Like for instance, India gave Sri Lankan government a huge amount of loan, because Sri Lanka is going through a horrible situation right now. So for Sri Lankan government, that will be capital receipt, loans from other governments. So likewise, there are various things. Then we have the expenditure budget. Expenditure budget is nothing but the expected or estimated expenditure of the government during the next 1 year. For example, if the budget is being presented in this Feb, that is 2022 Feb, the estimate will be for April to March 23rd, or not 23rd, April 22 to March 23. So this will be the budget estimated for next 1 year. So major components of revenue and capital budget. We'll stop here. We'll continue from here tomorrow morning at same time, 7:30, and we'll finish off this chapter and move to the next chapter tomorrow. Let me just quickly check how many more pages are there. So this can be easily covered tomorrow, and we'll move to Indian financial markets tomorrow. Most likely we'll be able to cover at least half of that tomorrow. Let's see how much we can cover, because there are so many things which are not important from the point of view of exam in financial markets. So I'll just quickly glance through those things. The important things, of course, I'll explain. Rest we can just glance. That is about financial market. Then we have Indian economy. This will be interesting. We'll do this in the next week. But tomorrow we'll be completing union budget, as well as, or rather I will try to finish the financial markets. That is lesson 5, I believe. Lesson 4, sorry. Anyway, that's all for today. Thank you. Before we proceed, one more announcement. So you may already be aware of this. Meenala madam is conducting classes on business communication skills. I would suggest, if you're a CSEET student, please do take it up, because it helps a lot for a student or for any professional as well to develop their communication skills. Not only CSEET students, anyone can actually take it up, or rather, all you have to do is just watch the class. So you'll get to hear useful stuff which you can actually incorporate in real life. So please do join Meenala madam for the business communication skills class, the details of which are there in the description.